On this slide, we're focusing on the essential concepts of repairs and improvements specifically for real estate investors. It's important to understand the difference between these two because they have distinct impacts on your taxes and overall investment strategy. Repairs typically involve fixing or maintaining property to keep it in good working condition, and these costs can usually be deducted immediately. Improvements, on the other hand, are upgrades or additions that add value to the property or extend its life, and these costs are generally capitalized and depreciated over time. Grasping these distinctions is the foundation of an effective investor tax strategy that can significantly influence your returns. Let's dive into why this topic is so important. First, cash flow can change significantly when a cost is deductible immediately rather than being spread out over several years through depreciation. This immediate deduction can improve your liquidity and financial flexibility. Second, misclassifying expenses can lead to serious legal risks. This includes potential audits, penalties, and the need to file amended tax returns, which can be costly and time-consuming. Finally, correctly identifying whether a cost is a repair or an improvement is crucial. It helps protect your investment basis, ensures your profit calculations are accurate, and keeps your tax records in good order. Understanding these distinctions is essential for every real estate investor looking to manage their finances effectively. When we talk about repairs, we're referring to actions that keep a property functioning as it originally did. Repairs are all about fixing wear and tear, any damage, or normal deterioration. The key point is that repairs restore the property to its prior condition without significantly increasing its value. Essentially, repairs help maintain the property's current state. On the other hand, improvements go a step further. Improvements actually make the property better than it was before. This might mean upgrading something to increase the property's value, extending its useful life, or adapting the asset so it serves a new or improved purpose. Improvements are investments that enhance. When we talk about repairs, we're referring to maintenance and restoration activities aimed at keeping a property in its usual working condition. Essentially, repairs restore something that's broken, worn out, or damaged, but they don't usually add significant value or extend the property's useful life. A typical repair focuses on fixing what's already there without upgrading or enhancing it. For real estate investors, understanding this distinction is crucial because repairs differ from improvements, and that impacts decisions around property management and financial planning. Remember, repairs maintain the status quo rather than creating additional value. Now let's look at some common examples of repairs that real estate investors often encounter. First, replacing broken windows is a typical repair that not only improves the property's appearance, but also helps with energy efficiency and security. Next, fixing a leaking roof is crucial because it prevents water damage and preserves the structural integrity of the building. Third, patching damaged drywall is often necessary to maintain the walls' aesthetic and prevent further deterioration. Lastly, repairing a faulty HVAC unit is important to ensure the property has proper heating and cooling, which is a key factor for tenant comfort and property value. Understanding these repairs helps investors make informed decisions about property maintenance and budgeting. When we talk about improvements in real estate, it's important to recognize that they're designed to add value, not just to fix what's broken. These are upgrades that go beyond basic repairs. They enhance the property's quality, increase its capacity, or boost its overall appeal. The goal is to create something better than what existed before, not just to restore it to its original state. Improvements can also extend the useful life of a property, going well beyond routine maintenance or minor fixes. Sometimes, this involves adapting the property for a new use, changing the layout, or incorporating higher-end finishes. As real estate investors, understanding the difference between simple repairs and value-adding improvements is key to making smart investment decisions that truly increase your returns. Now, let's talk about some common examples of improvements that real estate investors often consider. First, adding new flooring can really enhance the look and feel of a property, making it more attractive to potential buyers or renters. Next, Installing a modern HVAC system not only improves comfort, but can also increase energy efficiency, which is a big selling point. Another major improvement is replacing the roof. A new roof can prevent future costly repairs and significantly boost the property's value. Lastly, remodeling the kitchen is often one of the best ways to modernize a home and appeal to buyers, as the kitchen is typically a focal point for many people. Understanding these key improvements helps investors make informed decisions, balancing cost with potential return on investment. When we talk about repairs, these are usually deductible right away. Ordinary fixes like fixing a leak or repainting are typically expensed in the year you pay for them. This means you get an immediate tax benefit, which is great for cash flow. It's important to keep clear invoices to support these current deductions if the IRS ever questions them. On the other hand, improvements are handled differently. These are value-adding projects that increase the property's basis, like adding a new roof or expanding a room. Instead of an immediate deduction, the cost of improvements is generally capitalized and then recovered slowly over time through depreciation. Large improvement projects often bundle several capitalizable costs, so it's important to keep detailed, itemized documentation. Sometimes the same contractor visit may include both repairs and improvements, so distinguishing between the two on your records is crucial for accurate tax reporting. When it comes to repairs, an important point to understand is their deductibility. Repairs are considered current expenses, which means they can typically be written off immediately rather than being depreciated over several years. This immediate deduction reduces taxable income for the year the expense is incurred, which can boost cash flow in the short term, a big advantage for investors. Unlike improvements, which must be capitalized and depreciated over time, repairs allow for a full deduction in the year they occur. This distinction is crucial for managing taxes effectively in real estate investing. When we talk about improvements in real estate, it's important to know that these costs are capitalized, meaning they are added to the property's basis and then depreciated over time. This means you don't get to deduct the entire amount all at once in the year you spend it. Instead, the IRS requires you to recover these costs gradually. This gradual recovery is done through depreciation, which spreads the tax benefit over several years according to a set schedule. Understanding this distinction between repairs and improvements is crucial for real estate investors because it affects how you handle expenses and plan your taxes. Essentially, improvements add value and extend the life of the property, so they must be treated differently than simple repairs. When it comes to property maintenance and upgrades, making the right choice can be tricky because context really dictates the best approach. Take roof work, for example. Sometimes patching a leak is enough, but other times you might need to replace the entire roof system. It really depends on the extent of the damage and the long-term plans for the property. Similarly, with flooring, you have to decide whether to refinish the existing hardwood or install all new surfaces. Refinishing can be cost-effective if the floor is just worn, but if there's significant damage or you want a completely fresh look, new installation could be the better option. Then there's HVAC systems, where the decision often comes down to repairing a single component or upgrading the entire unit. Repairs might be sufficient if the system is relatively new and in good shape, but upgrading could improve energy efficiency and reduce future problems. In all these cases, there's a gray area where the right choice isn't always obvious. Understanding the nuances between repairs and improvements is critical for real estate investors to make informed decisions that preserve or increase property value. The key is to analyze the specific context thoroughly before committing to a strategy. When it comes to IRS guidelines and documentation, it's important to remember that the IRS focuses on what the work actually did rather than what you call it. This means every repair or improvement must be backed up with clear records that show the scope, timing, and cost of the work. First, keep detailed invoices from contractors that break down materials, labor, and exactly what was completed. This level of detail helps clarify the nature of the work done. Next, take before and after photos to document the property's condition at both stages. Visual evidence like this can be very helpful during tax assessments or audits. It's also crucial to record the dates when the work was done and specify whether it restored existing function or added new value. This distinction impacts how the expense is treated for tax purposes. Finally, organize all relevant paperwork, receipts, permits, contracts, and proof of payment in separate project files for each property and each project. Keeping everything organized makes it easier to support your claims and stay compliant with IRS requirements. When we talk about capital improvements and property value, it's important to understand how these changes affect your finances. Making improvements to your property doesn't just make it look better. It actually raises your property basis, which is the value used for tax purposes. At the same time, these upgrades can increase your resale value, so you benefit both in terms of investment and potential profit. But don't just focus on appearance. The right improvements add long-term equity, meaning they build real financial value over time. They also enhance your pricing power, allowing you to command a better price when you sell, and increase buyer appeal, making your property more attractive in the market. So, to sum up, a higher basis plus a potentially stronger market value means smart improvements can really pay off. Understanding these concepts is key for any real estate investor looking to make well-informed decisions about repairs and upgrades. When we talk about repairs, the return on investment is immediate. Repairs help maintain the property's functionality, ensuring it stays rentable and protected from more serious damage. Essentially, the value recovered through repairs is seen in avoided vacancies, consistent rental income, and reduced near-term risks. On the other hand, improvements have a different kind of ROI. They build value over time by enhancing the property's resale potential, strengthening its market position, and supporting long-term appreciation. While the financial benefits from improvements may not be immediate, they can significantly boost future pricing power and overall asset performance. So understanding the difference between repairs and improvements is crucial for real estate investors to manage their assets effectively and maximize returns. Repairs keep your property operational today, while improvements set the stage for greater value tomorrow. When we talk about cost segregation strategies, the main idea is to break down one property into multiple asset lives instead of treating every dollar the same. This approach works best when repairs, personal property, and building improvements are clearly identified and properly documented. First, separate the buckets. Instead of lumping everything into the standard 27.5 or 39-year building category, cost segregation reclassifies parts of the property into shorter-lived assets. For example, items like flooring, cabinetry, appliances, and certain land improvements often qualify for much faster depreciation schedules. Second, keep repairs distinct. Repairs that just restore the property might still be currently deductible, while true improvements need to be capitalized. A thorough cost segregation study helps ensure that improvement costs aren't grouped too broadly, isolating the components with shorter useful lives accurately. Finally, accelerate tax benefits. Assigning qualifying assets to 5, 7, or 15-year depreciation schedules allows investors to front-load depreciation, which can significantly boost early cash flow. This strategy is most effective when purchase records, renovation invoices, and asset-level details support the classifications. Understanding these distinctions between repairs and improvements is crucial for real estate investors aiming to optimize their tax benefits through cost segregation. When it comes to real estate investing, understanding the difference between repairs and improvements is crucial. But many investors make common mistakes in this area. One frequent error is expensing a full kitchen remodel as a repair. While small repairs can be expensed immediately, a complete remodel typically adds value and should be capitalized. Another mistake is writing off replacement windows as repairs rather than capitalizing them. Because windows often extend the property's life and increase its value, they usually need to be treated as improvements. Investors also tend to bundle minor fixes together and classify the whole as a major renovation project, which can complicate proper accounting. Additionally, failing to distinguish between routine maintenance and value-adding upgrades can lead to incorrect tax filings. Lastly, keeping poor records about what exactly was repaired versus what was improved creates confusion and can cause trouble during audits. Avoiding these mistakes helps ensure accurate financial reporting and maximizes tax benefits. When planning your budget, the first important step is making the right classification of costs. Separating repairs from improvements is crucial because it helps create a more accurate cash plan before the project even begins. Repairs typically support near-term operating budgets, since they can often be deducted in the current tax year. On the other hand, improvements should be placed in capital budgets. They impact appreciation and extend beyond just this year's cash outlay. By classifying costs early, you can better forecast the tax implications, reserves needed, and overall return on investment, reducing the likelihood of surprises down the line. This understanding is especially important for real estate investors who want to manage their finances effectively. When it comes to making high-stakes classification decisions, it's crucial to get expert input. These decisions can have significant financial and legal implications, so consulting a professional can save you from costly mistakes. First, if you're dealing with major renovations, meaning projects that replace entire systems, reconfigure space, or affect multiple units, it's important to have a tax advisor confirm what expenses need to be capitalized. This ensures you're applying the right tax treatment and staying compliant. Second, when you have an invoice that includes both routine maintenance and upgrades or betterments, professional help is key. A specialist can properly allocate costs between repairs and improvements, which helps protect your deductions and prevents misclassification on your tax filings. Finally, in cases involving complex ownership structures, lease agreements, or when you're facing audit risks, consulting a CPA or attorney is essential. These situations are legally sensitive, and expert guidance will help navigate the tax treatment correctly to minimize risk. These are the key moments when bringing in a professional really pays off to keep your real estate investments on solid footing. Here's a real-world example to illustrate the difference between repairs and improvements for real estate investors. Maria purchased a duplex and invested $8,000 fixing leaks, patching drywall, and repainting the units between tenants. These expenses are considered repairs and can be deducted immediately, which means she gets a faster tax write-off. On the other hand, she spent $22,000 replacing the roof and fully upgrading one kitchen. These costs are classified as improvements, so they must be capitalized and then depreciated over time. This means she adds this amount to the property's basis and recovers it gradually through depreciation. The key takeaway here is that repairs provide quicker tax benefits, while improvements increase the property's value and offer tax benefits over a longer period. Understanding this distinction helps investors like Maria manage their finances and tax strategies more effectively. When we talk about maintenance plans for long-term success, the key idea is that regular routine repairs are essential. They not only keep the property looking attractive, which protects curb appeal, but also build tenant confidence, making them more likely to stay. Addressing small maintenance issues early on keeps costs low and manageable, preventing minor problems from turning into expensive repairs. Consistent upkeep is crucial because it helps maintain the property's value over time, which is especially important for investors. By sticking to planned service schedules, we can avoid surprise capital expenses that can disrupt budgets. Overall, maintenance stands out as the most cost-effective strategy for preserving and even increasing the value of real estate investments. When we talk about market-ready upgrades, the focus is on making improvements that not only enhance the property's appeal, but also strengthen its position in the market. Updated kitchens and bathrooms are crucial because they create a strong first impression. These rooms are often the most scrutinized by buyers, and modern, attractive finishes can justify a higher price point. Next, energy-efficient systems are a smart investment. They reduce ongoing ownership costs, which is a big selling point for both buyers and tenants. Lower utility bills make the property more desirable and competitive in the market. Finally, Targeted finish upgrades are about making your listing stand out, especially in neighborhoods where many homes have similar features. By selectively upgrading certain finishes, you can capture attention more quickly and accelerate the sale or rental process. These strategic improvements together help investors maximize returns and maintain a competitive edge. To wrap up, let's focus on the key takeaways about repairs and improvements in real estate. First, repairs are essential to keep your property functioning properly, whereas improvements serve to increase the property's overall value over time. Next, it's important to know that repairs can often be deducted in the year they occur, giving you immediate tax relief, but improvements must be capitalized and depreciated over several years. The timing, scope, and intent behind each expense play a crucial role in how these costs are classified for tax purposes. Also, keeping thorough and accurate documentation is your strongest defense if the IRS decides to review your records. Finally, successful investors find a smart balance between taking advantage of immediate tax deductions through repairs and focusing on long-term gains through strategic improvements. Understanding these distinctions helps you make more informed decisions and optimize your investment outcomes. Now, let's focus on your action plan. First, review all active projects carefully. Make sure to list every current expense and categorize it as a repair, an improvement, or unclear. This step is crucial before year-end decisions are finalized. Next, build a habit of thorough documentation. Keep all invoices, before and after photos, contractor notes, and detailed scopes of work so that each cost has a clear tax story. This will make your financial records much easier to manage. Third, always plan with return on investment, or ROI, in mind. Distinguish between necessary maintenance and strategic upgrades, then prioritize the work that both protects your cash flow and increases property value. Finally, consult your CPA early in the process. Confirm how expenses will be treated before filing season to ensure capitalization, deductions, and depreciation are properly applied from the start. This approach will help you navigate repairs and improvements effectively as a real estate investor. As we wrap up, I want to highlight some important resources and next steps to help you with your future projects. First, keeping good records is crucial. It transforms those tricky tax gray areas into decisions you can confidently defend. Be sure to consult IRS publications like Publication 527 and Publication 535, along with the Tangible Property Regulations Overview, which provide valuable guidance. Also, it's wise to build a network of professional contacts. A CPA experienced in real estate tax can offer tailored advice, while a tax attorney is essential for handling complex issues. Don't forget a bookkeeper who tracks projects meticulously. That detail can make all the difference. For further learning, take a look at examples like IRS repair versus improvement cases, cost segregation case studies, and landlord accounting best practices. There's also some great recommended reading on understanding repairs and improvements for real estate investors. Finally, your next steps should include reviewing past projects by category to spot patterns, documenting project scope before you spend any money, and confirming your tax treatment plans with your advisor. Following this approach will ensure your projects are both well-managed and tax-compliant.